Ajay Srivastava, MD, Dimensionals Corporate Finance, now joins us live. Ajay, it's really been a long time that we have spoken to you, and clearly a lot has changed since then. Going into the Q3 numbers, how do you expect markets to react? Despite the expectation that the numbers would be weak, you think there is a fair bit of chance that markets may continue to see selling pressure after the corporate results?
I doubt it because I think the November results, in our view, will not be as weak as most people expect, because till October end or early November, there was no issue with the sales. Sales were doing very well for most companies. Even post the demonetization, you would have seen a huge bump up in sales, which is symptomized by the VAT collection, which has gone up in all the municipalities and all the cities that you see, Bombay, Delhi, etc. So, which is obviously the cash sale which happened in the system, etc. So, my guess is that December results are not going to be as bad because, one, the October till 8th November sales were good. Number two is lots of sales got preponed into that 1 week window where people and traders were expecting cash, etc. And therefore, the sales as a whole for the quarter are not so badly impacted compared to possibly will be the first quarter of this year. So in our view, I think there's a lot more pessimism on the sales front than what actually has transpired in the market. So I doubt correction will happen because of the results. I think correction, if at all will happen, is because of two reasons. One, disappointment with the budget. And number two is a little slowdown in the retail money coming into the mutual fund system. I think those are two triggers which can cause a slowdown, at least for the time being, because the market is kind of a status quo. It's against hope, reality, and it's going on at this point of time. So you've got to wait a while to see, but I doubt that the results of December will be as bad as people think it's going to be.
Right. In terms of expectations from budget, do you think markets is expecting a lot to come into this budget?
Well, we expect every year. So last year, yes, the budget was a turning point for the market. If you recollect it, market is still hoping that it's going to happen. Lightning going to strike twice the same place. It may not happen because I think if the budget had to do what it wanted to do, the Prime Minister's speech would have covered most of it. I don't think he would have left the thunder instead of 31st December to the 28th of February. I doubt it very much, or the 1st of February. So I guess there's going to be a normal kind of budget, normal scheme, allocation, same old story everywhere. And you may find comfort that we have met our fiscal deficit target, which on the contrary side is also telling you that as more and more resources move to the government, there's less and less money for private consumption or investment, which is now coming out in the market, where consumption and investment story both are going down. So I guess you can expect a euphoric, but I doubt it that PM has left some thunders for the finance minister rather than doing it on the 31st, which was most crucial to him. It was played up so much. So I guess the ammunition is spent.
As far as results are concerned, IndusInd Bank will declare numbers tomorrow. You think more than results, management commentary regarding the banking sector, when will the growth revive, how will loan growth pick up going ahead, all of that would be much more important?
See, if you look at IndusInd banks or Yes banks, they're not so dependent on the corporate market, really speaking, and their fee income has come out. The retail lending is a big chunk of them. IndusInd, of course, has got transport CV sector is a big one. My guess is that these banks have run their operations more shrewdly than perhaps the nationalized bank in the demonetization period, which is why you see that most of these banks did not have lines. They had closed their shop. They were not trying to give cash or bring in money or take out money. So in terms of just the pure numbers, my guess is that they would do much better. But however, the commentary is for all to see. The commentary is what? That the retail lending will come back. We will see interest rate margins may get impacted and so on and so forth. But the fact is that these banks, I think, will outperform the bigger banks. The smaller mid-cap, which is IndusInd, Yes Bank kind of stuff, will outperform. And I would kind of surprise the market with the kind of resilience they have.
Do you see that private banks in terms of valuations are now attractive after correction? There can be 1 or 2 quarters of impact, but you expect the private sector bank to continue to see double-digit plus growth?
See, double digit is right from 10% to 20%. I think that's the whole double digit. I don't think anybody is expecting beyond 20%, and the lower number is 10%. I doubt very much that the valuation intrinsically will change. The problem with the banks is today is over ownership. Everybody owns it, all mutual fund owns it, all PMS owns it, everybody owns it, which is why I'm alluding to the fact that if there is a slowdown of money coming into the system, that's the point of inflection when the banks are not cheaply valued by any stretch of imagination. They're very richly valued at this point of time. But yes, if more money comes in, they'll buy the same old story, so you might see some appreciation, which is why you've seen the last 8 months, the banking stocks have kind of been floating in a very tight range. They've not gone down, not gone up, because business is not going up, but the supply side buying is taking place, which is creating a bottom for these stocks. I doubt it that there'll be a tremendous re-rating in the market. You might see ups and downs, but 12-month scenario, all things remaining the same, or which may not remain the same perhaps, you will not find that the banking portfolio would have given you more than 10 to 12% return.
Right, but that now in context of rates being lower is decent, right?
Well, the rates being lower is going to kick both ways in. One kick is that how do you protect your net interest margin? When you are at 9% or when your interest rates are 12% and you borrow at 8%, it's easy to do a 4% margin. But when the interest rates kick down and you are lending now at 8%, etc., to bring the cost to 4% and keep the 4% or 3% NIM, that's not easy. So I guess the compression of margin is going to kick in as interest rates start to fall, because otherwise the fee income has to come on, and fee income can come on only when trade comes on. You know, bills of exchange, letters of credit, consumer loans come on, credit card outstandings go up. That's going to give a kicker, but that is not going to happen in the next 8 to 12 months, given the economic scenario that we are foreseeing. So I think to protect the net interest margin will be a big battle for these banks, because volumes will not make up for the shortfall in the net interest margin.
What happens with NBFC? Because they directly borrow from banks, so the rates are coming down over there. Their cost of funding will go down. Plus, there has been a bigger correction into NBFC versus the banking sector. Do you think that is looking interesting, or a little bit of more correction and then you would be selective into NBFC space?
You know, there is no way to call a bottom to the market, but the fact is that NBFC industry is in for a consolidation play. There are just too many number of players in the market, and at this point of time, with the competition coming from the banks in the same lending environment, you will see the fact that there will be a consolidation play, which means what? Which means that you need to stick to the top 4 or 5 NBFCs and buy them. I don't know what is the right bottom, whether you take a Bajaj Finance or Bajaj Finvest or whatever you other ones you call. Is the right bottom? I don't know the answer. But I guess is that if you want to start investing, you start buying chunks of it and keep building the portfolio. Because nobody can call the bottom. But they will give a serious competition to the banking industry, because people's money which is coming in 3 places. Bank deposits, the NCDs which all the NBFCs are raising money on, and the third part is the commercial paper market which corporates and all invest in. So, and banks are going to get more and more desperate to lend to NBFCs. So you will see that NBFCs with greater distribution power, greater risk management power will become stronger players and competition to the banks as compared to smaller. So go for the one. It's a consolidation play industry. You will see lots of players getting merged in this next 12 to 18 months. So the bigger ones will thrive and survive. The smaller ones may have to sell out cheap, because it's not going to be easy for them to raise money at a competitive cost. You look at the, NBFCs apart, look at Diwan Housing. Till 3 weeks back, it was raising money at 9.5 or almost 10% post its commission to this fundraising. Now, when the interest rates are down to 8.5% or 9% thereabouts in housing loan market, how does it kind of meet its profit margins? So the smaller NBFCs will find it much tougher to pass on. So if you want to invest in the top 5 NBFCs. Do not go in the bottom ladder.
As far as NBFCs are concerned, it's a very mixed sort of a sector. So the ones that you mentioned, housing finance, Bajaj Finance, an overall play. Plus you have microfinance, you have housing finance, you have NBFCs which are focusing only on the retail side of the market. A mix of all of them, or the leaders in any of these sectors, is a good portfolio to start buying?
I think, see, again, NBFCs is always has been revived in the last 2 years. The rating has gone up. If you look at the last 3 years back or 4 years back, there was no investor in NBFCs because earlier RBI governor's policy was to, kind of clamp down on NBFCs rather than let it thrive. Raghuram Rajan let them thrive and said, let them provide competition, which is a very good thing he did in the market. So we had it's a very 2 to 3 year investor-driven scenario for NBFCs, too short a period to take a call. But I think you need to build a portfolio as a counter to the banks because banks have a certain restraint on them for lending. NBFCs don't have. Like, for instance, lending against shares. The banks can't do it, NBFCs can do it, for instance. So I think that scenario is going to build up. Having said that, some marquee names have not performed. You saw some big farm NBFCs which had given equity interest to big private equity players. They have not performed in the market. So the distribution is more critical than just the NBFC name or the play or the segment. So you need to see people who have got a wide distribution network in this country can handle risk better. So build portfolios around those companies rather than just pure NBFC plays. And you've seen what happened to things like Religare, Finvest, etc. They are into serious problems because they worked in a different way, the investment banking NBFC scenario. So there will be NBFCs and there will be other kind of NBFCs which go on corporate transactional lending, which are going to be highly risky to invest in. So go for the one with retail franchise because that is where the action is going to be.
Right. Let's talk about commodity as a sector. Now, that's a sector which has done phenomenally well in 2016. Is it a sector which year after year continues to gain strength? We had seen a down cycle earlier in the last 3-4 years. You think that moderate returns can be expected in commodity sector?
Of course, yes. See, if you are basing the virtue of equity investment is twofold. The market is undervalued, one, and number two is that we are betting on growth in the Indian scenario. And so if you are betting on a growth in the Indian scenario, at end of the play is going to be the commodity play. I think there's no way out of it at this point of time. So you will not get those fancy returns you got last year, but a modicum of returns which will be on the upper end of the relative portfolio that you can build up will come from commodity plays. So look at mutual fund, look at independent plays, but commodities will definitely be in the top 25% of the industries which give you return or the sectors which give you return in the next 12 to 18 months. You can't ignore it, but you can pace yourself out because they have grown quite fast and ownership is also very large. So don't need to invest tomorrow morning, but pace your investment in it. But without it, I don't think your portfolio can beat the market in the next 12 to 18 months.
Right. But in the commodity, what do you like? So, you have steel, you have oil which moves separately, you have other base metal which move separately. Just any preference if you have?
See, very simple. Non-ferrous is a good preference to start with because steel is today totally dependent on the government policy. Today, if the import tariffs are removed, that steel is a bad buy. Now, how long can the government continue? How long can it justify to WTO? That's a temporary measure. We don't know. So steel, to my mind, is still a high risk, and because of the simple thing that the financials are predicated on continuing of the import tariff, which is predicated on WTO accepting India's temporary argument. Now, that is where the high risk comes in. So I guess is that non-ferrous is a better place to be than a ferrous at this point of time. If there's greater policy clarity on the tax issues on imports for steel, perhaps ferrous would become a better play as well.
Right. Oil marketing companies, do you think they would do well? Now, again, you cannot call them commodity stocks, but do you think oil marketing companies can get closer towards consumption multiples?
Of course. See, oil marketing is always a thumbs up for two reasons. One, in spite of the run-up, in our view, they're still undervalued given the franchise they command. And number one. Number two, their monopoly status is not going to be challenged. And number three, very important, this development which has taken place for BEML, for instance, where the government has approved a 26% strategic stake. I think sooner or later, this is going to come down to oil marketing companies because they're the most valuable franchises and there'll be enough buyers for this. This is one shares or one companies where there'll be a global players coming in and buying stock. So even on the fundamentals, the government is letting the pass through the cost increases, which means that no burden is coming on them. And as the prices go up, their margins go up quite obviously. Yes, there will be the inventory issues every quarter. Some quarters, they may even report a loss because inventory change may be very, very drastic. But having said that, on a longer term platform, these are reasonably valued, big franchises in a core monopoly market where if the government decides to sell its equity, either strategic or otherwise, in one or other companies, could become a big windfall. Therefore, you need to go into this sector 100%. It's a must-have in the portfolios as far as we are concerned.
RIL, ONGC, years and years they have not been performing. ONGC did well last year. Do you think these names can do well?
See, RIL, it's very difficult to take a name and then guess, because RIL has got a very complex set of situation emerging of telecom business, and whether it will be good enough for it to give a kick up, or whether it's going to be a Kingfisher story where telecom might bring the house down. We don't know the answers. So, you don't examine RIL on the basis of a story of petrochemical alone. It's becoming a petrochemical, others, and mostly telecom as to what happens to it. So leave that aside. I think ONGC is the production story. That's what I said. It's a production story linked closely to the oil prices. Unlike the OMCs, which are a franchise story. ONGC has got a monopoly, literally a monopoly for production in India. But that doesn't give it very much leverage, because you can import oil as well as you can buy from ONGC. But you can't distribute oil in this country without the OMC. So even if you've got a budget to invest, you would rather put money in OMC than ONGC, because ONGC's fortunes go up and down only because of oil prices. There's nothing more they can do. They're not having any major discoveries. There's not major any oil field from which you can expect a big bonanza to come through. So it's a pure oil play. You might as well buy oil futures and play with it, then take an ONGC stock. Maybe you'll get a better return because you have a very direct correlation with the price. So if you want to play ONGC, go buy oil futures. And if you want to play a oil game, you buy the OMCs.
Right. Let's talk about consumer as a pack, and let's just first start with the paint sector. It has seen a lot of correction. On the one hand, raw material prices are going up because crude prices are going up, and on the second hand, because of demonetization, you're getting slight bit of worried as to what will happen to growth. How will growth continue? Will it continue to be a structural story? But in this uncertain time, if the correction continues, it again quantifies as a buy.
See, theoretically speaking, there are only two companies in the paint sector, by and large, that you want to buy. So it's a question of whether at what stage you want to buy it if you want to do the paint sector. Paint sector is very intrinsic to the economy and real estate. If you see that if you believe in it, that the fact that India needs so many more houses and people will need to paint their houses again, you need to buy the paint story at some point and keep on with it, because it has to grow. That's the bottom line. The paint story has to grow, simple and straightforward. And number three, beauty is no new companies coming into the picture. So you're not seeing commoditization of the play. You're seeing a good quality company like Asian Paint, etc., commanding market leadership. So that continues. So paint is a sector which you intrinsically hold in the portfolio. Don't evaluate it day-to-day basis. Corrections will happen over time and you have to get out of it. The question is whether the real estate pickup will happen at what time frame, because they are directly linked to it. If real estate doesn't pick up, paint companies will have a very uncertain future.
Right, but some of these paint companies or some of these great brands like Havells or any other names, Voltas also for one, they are great companies which have very less debt, or rather no debt, and that's why even if the growth slows down, their valuations will not take a big hit.
See, they're already richly valued. See, we always started the premise they're good places to invest in. You ought to look at where they're valued. They're not cheap shares by any standard. If you look at the multiples, price to book, price to earning multiples, they're not cheap shares. They are expensive shares which have projected a fair amount of growth already in their share price. So therefore, when you're buying this share, the name looks good, industry looks good, everything looks good. But you got to pace your buying, because there is a growth story built into the share price, which the Indian economy is not showing up. So at some stage, the demand of shares is not going to translate into share price increase, which is what you have to guard against a portfolio, performing portfolio, non-performing portfolio. Names are very good. You don't have a doubt. You buy Aisha, you buy Asian Paints, you buy this and so on and so forth. That's a wonderful companies, big franchises. The question is, are you buying at the right price? Because profits mean entry at the right price, not exit.
Right. Ajay, just a last word. Do you think overall PSU names, whether it's banks, whether it's any of the names like BEML, BEL, they could do very well. Years after years, they have not been performing very well. Do you think that there is some amount of value into the PSU basket, which has recently started to go up?
You know, PSUs have been one of the best performing mutual funds in the last 12 months, for instance. Many people don't know it, but that's a fact. PSUs will perform because three reasons. They are undervalued, under-owned, and if government action of sale comes through, they give a bonanza. So I think this is a portfolio which is built on PSUs the current year. Last year has been a wonderful year for PSU stocks, maybe because led by oil marketing. This year is going to be as good for PSU stocks because they are undervalued, underinvested, and government action. 3 points for this time, which cannot be said for most other sectors.
Ajay, thank you so much for taking out time for us.